Trump has successfully gotten the market totally numb to Iran, right? And clearly, that's why we've had this rip the last 3 weeks. Private credit is this cycle subprime. AI is bullish until it's bearish, right? And it becomes bearish when people start. I think the world's gonna be divided into two kinds of people: the architects and the unemployed.
What's the primary safe haven investor should go to if this war escalates?
And I think, oddly enough,
Michael Gayed joins us once more. He's a founder of the Lead Lag Report. Michael, great to have you back. You're all in on AI right now. You told me offline. Now, personally, of course, are you all in AI on your investment side as well? Let's start with the fact that the iShares tech software sector is down 20% year to date, but the S&P is still up, in fact, at new all-time highs. What's going on?
First of all, you don't even know if you're talking to me or somebody in India using AI.
I was just going to ask you.
I think all these dating apps are beyond screwed. Because it's like, how can you trust anything on digital side? Yes, I'm very much all in on AI. I have, as I shared with you, I've spent literally in the last 7-8 weeks $40,000, not personally, my own company, basically setting up agentic AI for all kinds of aspects of my Lead Lag media business, separate from my Lead Lag Report research and my own funds. So I am very much all in from the standpoint of, yeah, this stuff is going to really replace a lot of industries. And I think that relates to the IGV point you just mentioned. Once you start getting deeper and deeper into agentic AI and seeing the capabilities and really kind of experimenting heavily, which can only really happen, I'd argue, if you have some ability to spend, because it's like a cost of tuition to learn how this stuff really works. You start realizing that a lot of companies on the software side will not make it. Now, that's largely been the reason for why you've had the software stocks collapse. I'd argue a lot of that is justified, but not all software companies are going to go away because of AI, allowing you to create customized solutions for your own company. Why? Because if you're a Fortune 500 company, you need somebody to sue. Okay, you don't want to do that stuff in-house. You're going to need some other larger entity, some other vendor that if something goes wrong, you're going to take them to court, right? And I think, oddly enough, having liability is oddly enough a moat. Is kind of a way to prevent, is a safety feature, arguably, for some companies. Now, we've talked about this with the free markets ETF, FMKT. My portfolio managers, co-portfolio managers, and I, we think actually that probably has bottom. The software overselling has probably bottom. You have to be selective if you're going to play in that space. But if the software side has bottom, then guess what? BDCs, business development companies, the private credit play, that's probably bottom for now too, because a large reason for why these stocks have gotten crushed is because there's been a lot of lending on the software side, on the private credit end. I have been very loud for the last year saying private credit is this cycle subprime. And nobody understood what I was saying until very suddenly it got into the headlines, some of these blow-ups. I myself think actually there's an investment opportunity now in some of these private credit public equity plays. Because there's an investment opportunity in the software plays, because there's been an overreaction on the idea that no companies will exist because of AI.
Overreaction or correct reaction, though? This is a chart, by the way.
I'll tell you in 2-3 years, I think is the way to say it, right? It's like...
Yeah, it's down. Yeah, it's down. I mean, just from a valuation standpoint, it looks beaten up. Everything looks beaten up right now, except, by the way, the S&P 500 itself. Bitcoin's beaten up, and gold's trailing sideways. Oil is... I mean, if you're an oil trader, you didn't have a good month for the month of April. But, by the way, Pierre Andouin's hedge fund lost 50% in the first half of April, according to Bloomberg, because he was long oil. So what are you long right now, Michael?
Not that hedge fund. I'll say that. Okay. I think, this is always a question of path and time frame, right? Okay. It seems to me that Trump has successfully gotten the market totally numb to Iran, right? And clearly, that's why we've had this rip the last 3 weeks in markets, right? The deal, they're going to make a deal. I don't know who the hell he's negotiating with, but he's going to make a deal with somebody. So the market doesn't care anymore about Iran. It's obvious. Now, it's been a very sharp move. The question becomes, what do you do about it after such a sharp move? To your point, you probably want to position the things that are most oversold, which again goes back to the contrarian plays, the software plays, the private credit plays. There's a lot of now that I think this Iran dynamic, at least for now, is kind of cooling. It looks like we're back on the deregulation side of things. Trump seems to be very adamant all around cannabis, recent news around reclassification, again, kind of getting the headlines. And then some of these psychedelic plays with I saw a headline around the FDA is going to somehow speed up the potential for psychedelics to be an approved treatment for certain ailments. That's a form of deregulation. That's something we're considering. These are all themes we're considering in our free markets ETF, FMKT. I think there's some really interesting things there. Look, as you have an aging population, older people want to smoke. Like they want their cannabis. They want their microdosing of psychedelics. There's the legit health benefits and physical benefits, with some of these treatments. So I think there's some interesting plays there. And I think you probably, energy might still keep on doing okay. But I think the real play is probably going to be anything bank related, anything financials related. Because again, this is where most of the selling has been and pressure has been focused on.
Well, why is the S&P ripping higher? What's causing this V-shaped recovery? There's still a war in Iran, by the way. Hasn't been resolved. Historically, wars don't seem to matter all too much, right? Unless you get some super spike in oil. Now, clearly, you're not going to have the reverse carry trade play out now. That oil spike, which was part of the thesis, was obviously not enough to cause Japan to panic and to cause some support on the yen. So we'll see. I mean, I think the market is trying to figure out where's the cushion. And the cushion's always going to be in the thing which has lagged the most, which might explain why you're seeing some real momentum in emerging markets, seeing some real momentum in small caps. I know tech is making a comeback, NVIDIA is making a comeback, but I think for the most part, you're likely to have some bigger shifts in things outside of the growth style. Okay. The notion that certain things lag the economy, certain things lead the economy, and ultimately lead markets, which is ultimately what the name of your publication is about.
Bro, it's the lag report. Come on.
Yeah.
It's like,
What is leading right now? Do you think oil is leading a consumer collapse? Do you think higher oil is going to cause demand destruction?
If you get another super spike from here, meaning if this Iran dynamic is not over and there's some other exogenous shock, yes. I mean, it's like I always go back to the idea that oil is deflationary when it's about the speed. If the speed of oil is vertical, if you have a massive spike, then that's demand destruction. I myself said the oil move is not inflationary. It's deflationary because the speed with which it happened, if it holds, is going to hurt margins. But again, if you come back in aggressively, maybe that gets countered. And there's a lot of studies around that. It's like, historically major recessions are preceded by major spikes in oil. So we'll see. Maybe that's coming. But again, it's like the thing that's nagging me about this environment is long duration treasury yields have not dropped to the extent that oil prices have dropped, right? So you had this pressure on yields because of oil rising. Maybe that's this disinflationary reasoning. But the fact that long duration yields have not dropped is a little curious to me. I would have expected that you would have seen them rush back into treasuries because now the conflict seems, at least for the moment in time, to be largely over with Iran.
Before we continue with the video, let's talk about your most important asset, your personal data and privacy. Now, your personal data is constantly being collected and sold and exposed online from places like shady data broker sites and even big data breaches. So your private information like your name, address, and phone number is out there on the internet, and it's easier to find than you actually think. That's why I recommend today's sponsor, Delete Me. It takes a few minutes to set up, and they handle the entire process. They find where your information appears, verify those listings, and submit removal requests to hundreds of data broker websites. They also continue monitoring over time since this data can resurface and reappear. I've been using it for over a year, and they have reviewed over 325 listings for my information. The reports show exactly what was found and what was removed, which makes the process transparent. Check it out now. Scan the QR code on the screen or go to joindeleteme.com/DavidLin, link in the description down below, and use my code DavidLin for 20% off. Take control of your privacy today. Now back to the video. What are the primary risks you're watching right now?
AI replacing me, I think, is the way to say it. I as much as I've just referenced the idea that some of these SaaS stocks have probably bottomed and there's probably some overreaction on the downside there. Again, going back to what I've seen and what I've built, 70 different agentic AI automations the last 70 weeks. The real risk is we are going to see, I think, a surge in unemployment. Like I believe now that I'm seeing it, now that I'm experiencing, now that I'm because I think I have the mind for it. I think the world's going to be divided into two kinds of people: the architects and the unemployed. Okay, and what I mean by that is the people that can actually figure out how to use AI and go all in. I think similar to what I'm doing, and everybody else that's basically is going to be replaced by that output. If that's the case, and I think it happens sooner than people realize, or sooner than people expect, then yeah, you're going to see some nasty volatility in equities. It goes back to the idea that AI is bullish until it's bearish, right? And it becomes bearish when people start no longer being able to.
Nasty for equities? Why would he be nasty for equities? Wouldn't you invest in a company that's highly more productive with significantly less SG&A costs paid to wages because of just higher AI and automation?
The answer is it depends on how quickly you end up having universal basic income to replace the lost consumer spending power that will come from all the people being unemployed by AI. Right? I mean, like that's. I do think Elon Musk is right. I've had the belief for a while. It's like we are headed towards universal basic income. We're heading to that because the reality is so many people are going to be unemployed as agentic AI keeps on taking over things, as robotics become a bigger and bigger dynamic of the workforce. And if that's the case, AI, I can tell you unequivocally, is much faster than most people's ability to think, which means they're not going to be able to reskill. And the last thing you want is people sitting around at home without an income. That's how you have a surge in crime, right? And the only way to prevent that then becomes you tax the AI companies, call it a dividend, the AI dividend, right? The efficiency dividend. And you give that money to people that AI has replaced. But you have to do that at that exact moment in time where people are being unemployed, because otherwise you are going to have this period where the consumer discretionary spending power drops. And that's where it becomes bad for stocks.
By the way, the UK government just paid more in welfare than they've collected in income taxes. Did you see this?
Yeah, that's not surprising.
Labor is spending more on welfare. For the first time ever, the Labor government is now spending more on welfare than is raised in income taxes in the 2025-26 financial year. Treasury raised £330 billion in income taxes. In the same year, the government spent $333 billion on welfare.
Yeah.
I mean, I understand that deficits are not like unique to the UK, but I don't believe in the US this has gotten that bad. So,
yet, and that's the point. It's like, and again, it's like the U.S. is politicians are very good at finding different words. Like I said, they're not going to call it a tax. They're going to call it a dividend. They're not going to call it welfare. They're going to call it what's the term? Abundance, right? It's like we're heading in that direction. Whether it's good or bad, I have no clue, right? I mean, maybe the utopian vision that Musk has is the right one. I have my doubts because I don't think it's ever that simple. But from an investment thesis perspective, it's like, all right, there's overreactions on narratives. There's people that are addressing and acting on AI without having ever used AI. And I think once you start to understand and go down the rabbit hole, as I have been with, and pure dollars tell you that I'm very serious about that I spent. Yeah, the ramifications are big, and it's coming sooner than people realize.
The bond market, 10-year Treasury yield has historically tracked inflation expectations. Is it going to do that again this time?
So, we speak about the lags. If you go with the idea that AI is inherently disinflationary or even maybe deflationary outright, yields have got to drop. I mean, flat out. Long duration yields really should drop to reflect that disinflationary pressure. To your point, in which case you would track inflation expectations on the downside. If it doesn't, I'd argue we have bigger problems to worry about, because if yields, 10-year yields do not track inflation expectations, then it's tracking default risk in the US. Hard to have default risk when you have a money printer, when you have military bases all around the world, and when you control the Strait of Hormuz, like the US is doing right now. So I think if you're looking for an opportunity, I think duration is the actually investment opportunity. As much as people think yields are going to keep on rising, quite the opposite. I would not touch, from a longer term perspective here at these levels, credit spreads. Like there's no juice in the high yield space, in the junk debt space, which still has higher yield, but the reality is there's no pricing of default risk there. Again, AI is going to cause companies to default. If it hurt private credit, it's going to hurt public junk debt. And while it might be an overreaction now, Bear Stearns happened, 6-7 months before Lehman, there were rallies in between that. Right? You had opportunities to make money in those very beaten down areas that ultimately did go bust, just with longer time.
So do you still like bonds then, Michael? I mean, you were all in bonds.
Yeah, it goes back to no. So I like long duration actually now more from an investment perspective than trading perspective, and I do believe that there's going to be a credit dislocation at some point. Which spread widening happens when you're at the narrowest credit spreads in history, like we are right now. Granted, I'm biased in saying that because I have a bond ETF, JoJo, junk on, junk off, that needs spreads to widen to really stand out. But yeah, I think there's the bullish on the tactical trade of the idea that the flight to safety in treasuries long duration works. And then there's bullish on long duration treasuries longer term because of the disinflationary effects of AI. It's like the meme that was going around, not really the meme, the thought going around at the start of the year, which something I myself have said before this on social media was, what if the real way to play AI is with long duration treasuries? Because if AI is disinflationary or deflationary, then yields at these levels will come down.
Michael, the lumber to gold ratio, which we talked about significantly before.
Yeah.
What is it telling you right now? Let me just pull that up as you give an explanation as to why we're tracking lumber to gold or why we should look at it. And
unfortunately, I had to close one of my own ETFs, Roro, that used that signal because the whole theory behind the lumber to gold relationship is that housing is the business cycle and lumber is a key component of housing. So if lumber is doing well, the expectation is that housing is going to pick up, and that tends to be a driver of the wealth effect, right? Housing. Unfortunately, for me, I launched that into a cycle where it's not about the housing market. It's about the AI tech cycle. Right? So it's like, that's why I closed Roro. Unfortunately, I didn't think that in 2021, AI would ever be a thing and that it would drive the economics of the world, basically. I mean, I saw this status. So some major sell-side research firm said the S&P is like 40% AI in terms of what's driving, the earnings and the performance. It's like, all right, that's it. The business cycle is no longer your house. It's digital, right? It is this AI dynamic. So right now it's, I mean, I haven't checked it too recently, but it seems to me like, if gold is kind of subsiding, lumber to gold probably should maybe start to bottom or pick up, but it's been a complete collapse as gold obviously has surged. I am not as bullish on gold here. I think if you're going to play risk off, I think you want to play it with the traditional risk off. We're going to re-enter that cycle at some point, which goes back to the yen and treasuries.
Michael, we got a few minutes left. Let's do a quick speed round. Gold, up or down by the end of the year?
Yeah, probably down.
Probably down. Why?
Because I have to hedge because I'm a fiduciary. It's like so compliance, man. Come on. I say probably because who knows? Like if you have another another flare up with war, it's like clearly that gold becomes a way to play that. And it's like I can't predict that. But I do think that gold in general, and I know this is lightning round, so this is long lightning round. Gold in general became a momentum trade, and it seems like for now at least momentum may have broken.
So, I mean, do you still believe in lumber to gold? I mean, do you still believe in that housing and gold show an indicator for what's about to happen in the economy?
I believe it's
this is the latest chart, by the way.
Yeah, I believe it's an indicator, but what I will say is that the moment I stop believing it, it's probably going to work because that's always how it works. Again, it goes back to the question of when will housing be the biggest driver of the economic growth trajectory? It's not now. It's very clearly not now. If it shifts back to that, right, then yeah, lumber to gold as an indicator is unequivocally a very strong indicator. Although I will say it's interesting, right, because it's like it looks like when you look at it, it did peak, before the Iran war, and which makes sense, and it's now picking back up. And if you look at the way the market's behaving, the market looks like it wants to go up. I don't disagree. What's
the primary safe haven investor should go to if this war escalates?
I'm pausing because it's like gold already has been a go-to. It may still be a go-to, which is why I just referenced that earlier. Listen, if war escalates, I still think it's long duration treasuries. I mean, it's a thing nobody wants to use as a hedge. It probably becomes the best hedge.
What about the dollar? With more demand for, I guess, alternative currencies, because the Iranians charge control than Bitcoin and Yuan, do you think this will ultimately spark a sell-off in the dollar as people flock to other currencies? Or do you think it won't matter so much? Okay, so I think the momentum on the downside for the dollar is real because the momentum in emerging markets on the upside is real, right? So if you continue to see, people being people, they're going to chase. They're going to chase emerging markets. They're going to sell dollars to buy
the emerging market currency to buy emerging market stocks. I think that dynamic is long overdue. Right? You've had a secular bull market in the dollar. For all we know, we could be in a secular bear market for the dollar. Right? But it's dependent upon continued outperformance in international assets. That's the key thing.
The notion that the Federal Reserve is going to print an obscene amount of money into this year to finance a widening deficit. Agree or disagree?
They can do it. I've kept on using that line on social media. They'll crash stocks to save bonds. It's like if you got to refinance, the best thing to do is scare the pants out of equity investors to force them into bonds as they're releasing bonds, right, to finance. I still think that's a scenario. I don't know how likely at this point, but it's a scenario. But policymakers just love printing money, man. I don't know what else to tell you. They just, anybody that thinks that they have to stop at some point. It's like,
so
sure about
are you bullish on stocks then if money supply is going to expand?
Yeah, it goes back to, it's a cycle question, and it goes back to which stocks. If you have money supply expanding, that doesn't mean that the S&P has to be the winner. I go back to money supply expanding may finally actually benefit emerging markets, may finally benefit small caps, may finally benefit BDCs, may finally benefit software stocks. It doesn't have to just go into, in quotes, the market, which is the thing everyone is already long, which is passive, large cap, S&P type stocks. You can have money flow into the areas which have done nothing for a long time. The emerging market side of things, it's true. If you look at it relative to the S&P, it's like, it's had a big move, but it's underperformed the S&P for well over a decade, and badly. I mean, if you believe that we're entering an environment where robotics are going to take over physical jobs, which is already starting. It's like you've got the AI on the brain, now you've got the robotics on the body. That's a commodity-driven dynamic. Commodity-driven dynamic benefits emerging markets. There's a direct link between emerging market outperformance and commodity strength and commodity demand. Right? It's like, so it almost seems to make sense to me that if you're going to have money supply expansion, it's going to find its way into the things which probably need the money the most.
Last question. Anything you really like right now?
Well, I like this channel. Everybody that's watching should like and subscribe. David Lin's channel here. I'm biased, of course, but I really think the deregulation thing is real. I mean, that's why I launched the free Markets ETF, FMKT. I mean, I'm biased. Again, I brought it to market, investing in companies that benefit from deregulation. But I think there's so much untapped potential that deregulation unleashes into the broader economy and into specific industries and sectors. I think the cannabis play is real. I think the psychedelic play is real. I think that, yes, I do actually think the Bitcoin crypto play is real. And that could be another catch up to your point about money supply expansion. And the nuclear play is very real. Nuclear is not going anywhere.
Okay, excellent. Where can we follow you for now?
Everywhere, as things say.
And we want to follow the real Michael, by the way.
Yeah, not the agentic AI side, which is actually much nicer than the real Michael. Real Michael's not here, actually. I'm somebody in India right now. No, the at Lead Lag Report on X, on Lead Lag Media, on YouTube, Instagram, Lead Lag Report. I mean, pretty much anywhere and everywhere you can think of, I'm probably somewhere that you see content.
Excellent. We'll put the links down below. Make sure to follow Michael in the description down below. Thank you so much, Michael. Appreciate your update.
And by the way, I gotta say, you look killer, David. You look like you lost some weight. Your hair is always phenomenal. I don't know if that's AI, right? It's like it could be a filter also, but
no, you just inspired me to work out more. So
dude, I was doing AI automations up until 3 a.m. I woke up at 7. I still hit the gym. No excuses.
I mean, this is, by the way, we're going to close off here, but 20,000 job cuts as Microsoft raised concerns that AI-driven labor crisis is here. Some people say they're using this as an excuse because they overhired during COVID. I don't know.
There's probably some truth there, but I disagree. I think once you start seeing, you have to do it to believe it. And by the way, I've been one of those skeptical guys on AI. I was very wrong, dead wrong for a couple of years on NVIDIA. This is different than just doing a prompt. Now that it actually does things, as long as you have the right mindset for it, you start realizing, wow.
So the key takeaway is that our jobs are all at risk. Is that what we're getting out of this?
It's like I said to you 2 years ago about Japan, but in that case, I was at least right for a little bit of time, but then mainly wrong. I said it means we're all I think is that's going back to that quote from the very eloquently said quote about Japan. Right. It means AI is going to replace all this. What's going to happen is we're going to enter a world where the only thing that's going to matter is going to be in person. Everybody that's watching this, if you want to do anything to better yourself to survive, you better sure as hell be charismatic and be able to develop relationships. because
All right.
AI might get you leads, it might get you prospects. You still got to close.
Unless the customer is AI. That's a different story. Thanks, Michael. We'll speak soon.